Now, I should mention the federal estate tax. If the estate is large enough, and in 2019 that means $11,400,000, whether your plan has a revocable living trust or not, the federal estate tax return will be required. Also, for married couples, if the surviving spouse wants to take advantage of the deceased spouse's portable exemption, the federal estate tax return will be required even if the estate is small and whether or not your plan has a revocable living trust. Keep in mind that the federal estate tax has become a political football, even though the exemptions are high in 2019, as this update is being prepared in June 2019. The exemption is scheduled in 2026 to return to 2017 levels. That would be $5 million before an inflation adjustment. Much lower exemptions could come earlier depending on election results. Some proposals include an exemption that is reduced to $3,500,000. So, even though the federal estate tax may not be a concern for almost all of us now, there is a real possibility that by the time you or I pass away, it will become a concern even for the estates of many members of what they call the middle class. Let's talk about accounting requirements. Fiduciaries, whether an executor or trustee, must pay attention to accounting requirements. Whether your plan uses a revocable living trust or not, there's a fiduciary involved who is trying to settle things for the benefit of other people. By fiduciary, I mean somebody like a trustee or an executor who has duties to the people who are supposed to benefit from the property the fiduciary manages. It will be the job of the trustee of the revocable living trust, ultimately, to account to the beneficiaries of the trust. That means being able to account for every penny. Accounting is a precise process. As the trustee, you start with the list of assets that exist at the time of death, and you include every penny of income that comes in. That means, for example, every dividend, interest, and rent payment. You also include the transactions that have occurred, such as sales and exchanges, and you include the debts, expenses, and taxes that you paid. The trustee should provide the beneficiaries with a report on what is left over after all of that and how the trustee intends to distribute it. If you're a trustee, then as a trustee, you want to be able to show the beneficiaries that you, as a trustee, have done a good job and that there's no reason for the beneficiaries to be critical of you. Based on that, you'd want to ask the beneficiaries to release you from any liability. As a fiduciary, you can't expect the release that you get from the beneficiaries to be 100% enforceable unless you provide them with adequate disclosure. That's one of the rules of being a good fiduciary. Before you can get an effective release, you really need adequate disclosure. In Connecticut, a difference between a plan that avoids probate by using a revocable living trust and a plan that does not avoid probate is that with a revocable living trust plan, you're not required to file the accounting in the probate court. Although, in many cases, it might be a very good idea to file the accounting with the court and to ask the court to approve it, there's no requirement that you do so. On the other hand, in Connecticut, when a revocable living trust is not part of the plan and probate is not avoided, the executor is required to file an accounting in the probate court. Early in this video, I talked about how a trust can be established by the terms of a will. You might remember the example of the single mother who wanted to create a trust for her daughter, and the trust was created under the terms of the will. Her will said, "I give all my assets to my trustee to manage for the benefit of my daughter." You can have that type of arrangement either in a revocable living trust or through the terms of your will without a revocable trust. The question for that single mother is it better if the mother, after her death, sets up such a trust for her daughter by the terms of a revocable living trust or instead by the terms of her last will and testament? Some believe that there's an advantage in using the revocable living trust so that the trust for the daughter will not be under the supervision of the probate court. By using the revocable trust to avoid probate, the expenses related to probate accounting proceedings could be avoided. If the revocable trust plan is not used and probate is not avoided, the trust for the daughter would be established as part of the Connecticut probate process. In that case, the trust would continue to be under the jurisdiction of the probate court in Connecticut. If the trust is subject to the jurisdiction of the probate court, the trustee is required to file accountings in the court on a periodic basis unless the will waives the accounting requirement. Keep in mind, however, the probate judge usually will have discretion to order an accounting if the court at any time deems it appropriate. Even if the will waives periodic accountings, in Connecticut, the trustee of the trust under the will be required to prepare and file a final account in the court. Some people think that's a good thing because it keeps the trustee honest. Other people think that's an unnecessary and expensive intrusion. It's a fair point. There are many states that don't have such a requirement. In those states, the trustee can settle matters with the trust beneficiaries outside the court. But the reality is that when nobody is watching the trustee, some trustees become lax about performing their accounting duties, and they fail to keep good records. Trying to figure things out after neglectful management for a long time can be a nightmare when it comes time to terminate the trust. Probate court involvement can help keep things from getting out of control. Let's talk some more about the reasons why someone might want to consider taking advantage of a revocable living trust plan. As we've gone through this presentation, we've already touched on many of the reasons, and there won't be a need to once again go into all of them. One reason that I stressed earlier, however, should be emphasized. We think that the most important reason for considering a revocable living trust is that such a trust provides a good way to manage your assets when you need it, especially during incapacity. In other words, when you're just too tired or frail or not capable of managing your assets anymore, the revocable living trust is a good vehicle for dealing with that problem. Also, we previously talked about if you have real estate in more than one state, how a revocable living trust can be helpful in avoiding ancillary probate proceedings in those states. In our next segment, we'll cover something we haven't mentioned before. We'll cover how a revocable living trust can help when you have a controversial estate plan.